REITs have fallen badly, but I'm not afraid. In fact, I think many of them appear to be very cheap to me. But when I say cheap, it also does not apply to all REITs because different REITs are in different sectors, and in particular, today I'll be highlighting one sector which I think has certain risk and problems, and that is none other than REITs with assets in US commercial real estate. Now, right now, these are 4 REITs that focus in that sector, and as you can see, they're giving more than 10%, double-digit yield, correct? Keppel Pacific Oat is giving 12.94%. Manulife REIT is giving 16.15%. Wow. At this kind of yield, right, how do you find yield accretive deals to do M&A? So that's a problem in itself. So in today's discussion, I'll be comparing these REITs against REITs with office assets in Singapore. I'll show you the data points as well as help you understand the risk as well as opportunity that could be presenting. And not just that, I'll be showing you data points from CICT's latest third quarter 2022 report. So if you're keen to find out a bit better, continue watching on. Hi guys, welcome back. The reason these 4 REITs are showing such a big double-digit yield is because their share price have came down tremendously in the last few months. These are the 4 REITs that I showed you just now, and as you can see the share price, they've all tumbled 30 to 40 or even, in fact, close to 50%, especially for Manulife US Real Estate Trust. Now, that REIT in particular is the oldest one in Singapore when it comes to focusing on US commercial. So later I'll be using that as a key discussion point as well as a comparison against other Singapore office REITs. Now, if you look around for headlines, you realize that US REITs have fallen deeper into negative territory in third quarter 2022, and they've even underperformed S&P 500. Now, this video is sponsored by Weibo, and if you would like to buy US stocks or if you want to buy S&P 500 ETF, you can actually use Weibo because they have $0 in commissions. I'm a user of the platform, and as you can see over here, the user interface is very simple to use. Not just that, right now Weibo has a special promotion. Simply open an account today, deposit $2,000 and make at least one buy trade of a stock or ETF worth at least $100 within 30 days. And you get for yourself cash vouchers of US dollars 100. The other 50 is if you do options trading. So in total, 150 US dollars worth of cash vouchers. Thank you for supporting this channel. Use my referral codes below, and let's dive back to our tutorial. But then again, it's just one quarter worth of data. If you compare 1 year against other office REITs in Singapore, you also see a startling story. As I mentioned, Manulife US REIT is the oldest one that is focused in this sector. So I'll use it for comparison. And I compare against Keppel REIT, which is fully focused in Australia and Singapore offices, and Suntec REIT, which focuses in Australia, UK, and Singapore offices and malls. Suntec REIT is of course one of my preferred ones. But as you can see over here, you realize that in the last 1 year, Manulife US REIT, which goes with the ticker MUST, is really underperforming both of them massively, correct? Total losses for 1 year is close to 50% already. So that's why it got me curious, and I went to dig up on the books to really think through whether this is an opportunity. Because I've also seen comments before whether MUST is a good investment right now, especially when the yield is so big, 16+%. So when I dig into the report, I discovered some things. The distribution per unit has dropped slightly to 2.61 cents. Not a problem, especially when net property income has on paper increased to $57.6 million. Gearing ratio, no issues with that. Fixed rate loans are more than 85%. So that is actually insulation against rising interest rates. Of course, when certain of their debt matures, they do need to refi at a higher rate. So that definitely has some impact. But if you look in terms of the occupancy, you see it's 90%, way above US Class A officers rate. So what's the big problem going on? I discovered this. You realize that the physical occupancy is only at 28%. I actually do not see this disclosure in other Singapore office REITs also. So I think there's something brewing in US offices. When I look around for analyst report, I realized that this is something mentioned about US offices. The return to office rate has been slower than expected, with physical occupancy averaging around 50%. Just now, MUSTs is only at 28%. So some of them have it a bit better, 60-70%. So the climate is definitely different from Singapore. You know, in Singapore, everybody's going back to offices. I can feel it already. When I meet clients, I meet them in offices. or when I do Zoom calls, some of them have office in the background itself. So I know, and in fact, you may be also agreeing you are back in office yourself. So US side, different cities have different climate, different problems in terms of supply and demand. But I guess what they're seeing there and what we're seeing here is vastly different. In Singapore, everybody's going back to offices. In US, different cities practice different things. But everybody is really doing a lot more hybrid work and work from home. And they're sticking to that. Maybe the distance to cover is very big and they're not really keen to move back to the old days of going back to offices. Again, Singapore offices are doing a lot better. If you see from CICT's report, realize that Grade A rent have been climbing, correct? This reflects a growing occupancy. This reflects a strong fundamentals to the office supply and demand and usage. So as you can see over here, the second quarter 2022 report suggests yet another climb, and this is already close to pre-pandemic levels. The strong occupancy can also be detected because suburban malls are doing very well. Now, this recovery can be seen in this snapshot over here. Realize that downtown mall retail portfolio is up 36.5% for tenant sales, even more than suburban malls. So downtown malls include Plaza Singapura, includes Marina Square, etc., etc. So that, as compared to Causeway Point, whereby Fraser Centrepoint is focused on, you realize that downtown malls are really recovering at this later stage of this pandemic. But back to US offices. For my further research, I realized more startling data points. You see in this snapshot over here, they've mentioned they are giving concession packages, which means they're giving rent-free and some allowances to retrofit the offices. What are they retrofitting? Because this is rent loss, right? Or some cost given back to the customer itself. My guess is that there's a lot of subleasing because they are now doing a lot more hybrid, which means offices there are no longer the same as before pandemic already. Subleasing is pervasive, and we can see in this bottom right hand chart over here. And the impact of it in totality is the top right hand side. The net effective base rent, which is the dotted line over there, has declined because they are giving a lot of these concessions and subleasing and rent-free for retrofitting. And all this is costing money to landlord, whereby you are that person if you are the REIT owner. All in all, I think there are confirmation signs to show that in US offices, the problems may be permanent. That is why I've seen this report mentioning that Manulife US REIT is looking to do hotelization of their office assets. Wow, this is a permanent change away there, which means they kind of have given up. Again, it's mentioned in this article, they only see a 28% physical occupancy, which means sooner or later, their tenants will give up, because if they are not coming back, why is the tenant renting the place? That will impact rent income. That will eventually lead to write down of the asset value itself. So if they are looking to do hotelization, I think that's going to cost a lot of money, and that is going to be a big hit in terms of the portfolio. That's why the markets are selling down these REITs that aggressively. All in all, I have this conclusion to share with you. Markets are always forward-looking. If they smell risk already, you can assume that Mr. Market is selling down ahead of that risk. It's not giving you a free lunch. So if you see 16%, think very carefully whether you are in tune with what's happening on the ground versus in Singapore. Don't assume we are seeing the same climate. Don't assume the risk is not present. And last but not least, big rounding point, don't buy a stock just because of the dividend yield. That is dangerous, and hopefully this message has been useful. As always, smash a like, smash a subscribe. Especially in the next episode with this, I'll be touching on Parkway Life REIT, which is a strong REIT that has also overseas assets. I'll use that as a comparison for you to further understand and further refine your own investment process. Stay tuned for that, and I'll see you there when it's released also. Take care as always, invest safe, goodbye.